Let's discuss the concept of cost of capital first. So what actually cost of capital is? So cost of capital is the average cost that a business needs to cover. For example, you want to invest in a project and the project requires equity and it also requires debt. Now, the total investment required in the project, for example, is, to make things simple, $200. 100 you will invest through equity and the other 100 you will invest through debt. So this makes 200. Now, equity is something that we raise using our shareholders. So our shareholders will invest. So $100 are a one that we raised through our equity holders and shareholders, and they do require return. So the return that shareholders require is, for example, 15%. So our shareholders said, okay, we are giving you this equity, but we need return of 15% on this finance. When we went to bank, so bank also requires interest on the amount that bank is giving you as a loan. So that is a loan. It is separate from equity. So there is a difference between these two. And there is a difference between this return and the interest rate. So we will discuss that difference as well once we move towards Islamic Code of Finance, which is part of our financial management syllabus. So this interest rate is 10%. Now, 100 we got from equity, 100 we got from debt. What we need to make sure is that we need to cover 15% and 10% for sure. So once we average this, but the way to calculate average is different, and that is why we call that average as weighted average. So we need to work out weighted average, and for example, the weighted average here is 12.5%. So we are not going into the calculations of how weighted average calculation will be done. That we will discuss in our next section of weighted average cost of capital. So this is 12.5 and this is known as weighted average cost of capital. So this average will make the life easier. This will give clear idea that the project should cover 12.5% cost of capital for sure. If this project has to be a viable one, it needs to cover this 12.5% minimum cost of capital. So this is the minimum cost that the project should cover in order for project to be acceptable. Because the funds through which you are investing in this project, so the project should ensure that it should cover the cost of those funds which the business is actually using to fund that particular project. If that project fails to cover the cost of this finance through which the project is being financed, then the project is not at all acceptable. It's a useless project. So this is the minimum cost the project should cover, and NPV now plays a major role here, as NPV will help you to decide whether to opt for a project or not. So coming to the next important area is the decisions that a business needs to take on the basis of NPV. Now there are different possibilities and yes, different decisions. So the first is, if I write here the decisions that the business will take and the basis behind that, the rationale behind that is what we need to discuss as well. Possibility one is when the answer of NPV is positive. Now, if the answer of NPV is positive, what decision we need to take? Simple. The decision is accept it. Simple. Accept the project. It's positive NPV. Okay. Now, what is the basis behind accepting the project? So, it's very simple. The first is that the project is covering the cost of capital, for example, of 10% if I use that same question figure. So, it is covering the cost of capital. So, this is the basis number one behind that. It is covering the cost of capital because the answer is positive. And the second thing is, it is not just covering the minimum cost of capital, but it is also generating wealth. So, it is also generating wealth for the shareholder. So, wealth generation is also there. And this wealth generation means that shareholder wealth is increasing. So, by the amount of 58,000, if I use that previous question, so approximately it's 58,000 by which the NPV came positive. So, if I round off this to thousands, it's 58,000. Approximately the NPV is positive by 58,000 or 59,000. I hope this is clear. Now, you need to make this clear in your mind that if it is positive, okay, accept it. But why? Why? So there are two bases behind that. Number one, it is covering the minimum cost of capital. Also, it is generating wealth. So, the extra amount, the additional amount, the net positive difference, which is known as NPV, is the amount by which the wealth is being generated, which is here 58 or 59,000 if we use the previous question numbers here. So, the amount by which the net answer comes positive, that difference amount, that positive differential amount is known as NPV, and this is the amount by which the wealth is generated for the shareholder. So, this is the basis.